And that does it for today's trading action. All three of the major averages holding on to gains, although closing well off the highs of the day. Dow up 335 points, the third day of gains in a row there for that major average. S&P up just around 0.5%, as well as the NASDAQ. Let's talk about the gains that we've been seeing, whether or not it's going to hold. And for that, we want to bring in Scott Ladner, Horizon Investments Chief Investment Officer, and Rebecca Felton, RiverFront Investment Group Senior Market. Rebecca, I'll start with you. When you take a look at the gains that we're seeing play out today and what we've seen over the last several trading days heading into the results tonight and what that typically means in a midterm year between now and the end of the year, the trading action that we'll see, what do you think is most likely?
Well, thank you so much for having me. And certainly history tells us that post midterms markets typically do well, but we have so many mitigating factors when we think about what we are experiencing right now as it relates to what's going on with the Fed, the inflationary pressures, what we're seeing in terms of what the companies have told us as we've navigated through third quarter. So certainly those historical numbers would be appealing, but we have to think about the other factors that are at play here.
And Scott, when we look at the market action, they seem to be oblivious to what's happening with the midterms, clearly looking further forward than that. What do you think the markets should be focusing on right now?
Well, look, I mean, I think Rebecca's generally right. I mean, markets tend to do pretty well after midterms, but she's also right that there's a lot of cross currents going on right now. And so, the Fed is probably the most important one of those things. And getting some clarity as to kind of how they're thinking about the world. We actually got that over this last meeting. And so, right now, what the market's trying to do is figure out what is the right discount rate to discount earnings back, and how bad is this recession that's coming going to end up being? So, like, what are earnings going to look like? Right now, the market has earnings priced at around $225 for 2023. We think that probably needs to come down 5 to 10% for sort of a mild recessionary type of outlook next year. And that sets us up to bottom sometime in the, like late fourth quarter, early first quarter, and then be able to stage a pretty meaningful rebound off of those lows. But we still do think we have a little bit of wood to chop. And we do have these kind of weird risks out there in the market, as you guys alluded to earlier with this FTX and Binance thing really ruling the market action today.
Yeah, Rebecca, I'll be watching election results all night and probably Georgia for the next, 30 to 60 days as they do a recount there. But I think Thursday with that CPI numbers, the markets really need to see what comes in there. What's your expectation for inflation Thursday and the months ahead?
Well, there's no reason to believe that we won't hit that consensus number. I think it's 0.7 month over month and 8% year to year. But even then, we are still far above that 2% target. And when you think about the wage pressures we're still experiencing, and certainly the energy cost, whether you're talking about transporting goods, heating bills as we head into winter, there are so many factors that are going to keep these pressures higher than where the Fed wants them to be. So we don't believe that the Fed is going to ease up at any point in the near term. And so rates will stay higher for longer, and inflationary pressures clearly are likely to stay higher for longer, too.
Do you agree with that, Scott?
Yeah, look, I mean, there's a lot of deflationary pressures in the pipeline. We've seen what's happened with commodities, industrial commodities. We're seeing what's happening with prices paid in some of the survey data. We're seeing that the small businesses don't think they can raise prices anymore, really. So we kind of know what the story looks like 3 to 6 months hence. The problem is we don't really know what it looks like from now for the next 3 months. And so but the market's going to trade off of what it looks like between now and the next 3 months. So we're not terribly concerned about the inflationary outlook as we get into the first quarter of 2023. But these next few months could be kind of rough and really sort of like random number generator type of rough. We just don't know what these month-to-month prints are going to look like. There's so much volatility in these data, and so we do think it's an environment that you need to be a little bit cautious in, just like knowing that. But we do feel pretty good about the disinflationary that's in pipeline. It's just got to get through the system, and it's got to get in consumer prices, and that's usually like a 3 to 6 month process.
So, Scott, how would you assess what we're seeing with consumer spending and then what you call the quizzically strong labor market? Though it's softening, but clearly what the Fed is doing isn't quite making the dent that it wants.
Well, I mean, there's no reason to expect that it would necessarily. I mean, they've hiked really, really quickly, but the consumer is sitting on a boatload of cash, and we're coming up in an environment where companies couldn't hire anybody, and so they're very fearful of firing anybody, outside of the tech realm. And so, with this, it's this weird backdrop where we kind of know what's coming. The Fed kind of knows what's coming a little bit, probably as well. but they're scared to admit that they were wrong last time. And so they're going to over-tighten this time because they think from a risk management standpoint, they have the tools to deal with the recession. And they're finding that their tools to deal with inflation aren't working quite as quickly as they would hope that they would. And so, in terms of the overall outlook, we think it's going to end up being pretty good. But we got a few months where we got to get through in terms of like the labor market and it remaining kind of this very strong labor market, these very strong prints with kind of all these cross currents going on, even in the face of a place where businesses know that the demand shock is coming. They know that the demand's coming down. They know that we're coming into a little bit of recession, but they're just scared to fire anybody yet. And the Fed wants them to fire people. The Fed needs companies to fire folks over the next few months, and then they can take the foot off the brakes. But we have to get to that point. It's just going to be probably a choppy couple months until we get there.
Yeah, it's some interesting news on that front, Rebecca. As the Wall Street Journal reports, Mark Zuckerberg says he is accountable as company preps for mass layoffs could begin as soon as tomorrow. Will the Fed get what it wants, Rebecca?
Again, I think we think it's going to take some time. We have heard as we've navigated through earnings season, a number of companies cutting hiring plans, putting freezes in place, and even laying off workers. And in your segment before, when you were talking about credit card debt and the consumer, according to the National Retail Federation, folks have said that they're going to spend as much this year as they do on average, but we're also seeing the credit card delinquencies creep up. We're seeing rent, people falling behind in their rent. There's an awful lot at work here. And so we know also with respect to the midterms that inflation was the biggest issue for voters from both parties. So it is going to be choppy. It is going to take a while for some of these things that have eased to show up in the numbers. So it's probably going to be a tough period from now until January.
Well, a big thank you to Scott Ladner and Rebecca Felton for breaking down today's market action with us. Have a good afternoon, guys.